What if I told you that the stock market made 18% last year and you still got poorer? Not in theory, not as some economic abstraction, actually measurably, verifiably poorer in terms of what your money can buy in the real world. Ray Dalio looked at 2025's market performance and said something that almost no one in financial media picked up on. The S&P 500 returned 18% in dollar terms, but measured in gold, the S&P actually fell 28%. Your portfolio went up, your wealth went down. And the gap between those two statements is the most important thing happening in markets right now. Today, Ray Dalio explains exactly how this is possible, why it is going to get worse in 2026, and what the people who actually built wealth last year did differently from almost everyone else. Let's get into today's video.
I want to start with a question that I think almost nobody is asking, and that I believe is the most important financial question of 2026. What currency are you measuring your wealth in? It sounds like an odd question. Most of you are measuring it in dollars. Of course you are. You live in America, your salary is in dollars, your mortgage is in dollars, your grocery bills are in dollars. Your retirement account balance is displayed in dollars. The dollar is the water you swim in, and most people never think to question whether the water itself is the problem. But here is what I said at the beginning of this year after reflecting on everything that happened in 2025. And I want you to really hear this because it reframes everything you think you know about how your investments performed last year. The best major investment of 2025 was gold, not AI stocks, not the S&P 500, not real estate, not crypto, gold. It returned 65% in dollar terms. That means if you held gold through 2025, you made 65 cents on every dollar you invested at the start of the year. The S&P 500 returned 18% in dollar terms. That sounds pretty good by historical standards. An 18% year for the stock market is what most investors would call a great year. They would feel good about that number. They would feel like their wealth had grown. Now, here is the sentence that I want you to sit with until it fully lands. The S&P 500 fell 28% in gold terms, not rose, fell 28% in a single year. The index that most Americans are counting on to grow their retirement accounts declined by more than a quarter of its value when measured in honest money rather than the money that the Federal Reserve can create with a keystroke. Your portfolio made money last year, and you actually got poorer. Both of those things are true simultaneously. And understanding how both of those things can be true at the same time, understanding the mechanism that makes them possible, is the single most important financial concept you can learn in 2026. Because it is not a phenomenon that ended on December 31st of last year. It is accelerating. And the people who do not understand it are going to keep feeling like they are getting ahead while they are actually falling behind until the gap between the number on their screen and the purchasing power that number represents becomes too large to ignore. By then, it will be too late to do much about it. The illusion of nominal wealth and the brutal reality of real wealth. Let me explain the mechanism, because once you understand it, you will see it everywhere. In your salary negotiations, in your retirement projections, in the way the financial media reports market performance, in the way politicians talk about economic growth. Once you see it, you cannot unsee it. Nominal wealth is the number on your screen. It is the dollar figure in your brokerage account. It is what your house was appraised at. It is the number your financial advisor shows you in the quarterly report with the upward sloping line that makes you feel like everything is going in the right direction. Real wealth is something different. Real wealth is purchasing power. It is what that number actually buys. How many meals? How many gallons of gas? How many square feet of housing? How many hours of health care? How many years of comfortable retirement? Real wealth is not a number. It is a capability, the capability to acquire real goods and real services in the real world. And here is the problem that is getting worse every year. The dollar, the currency in which nominal wealth is measured, is losing its purchasing power. Not dramatically in any single month, gradually, persistently, in ways that are almost invisible in the short term, but that compound into something devastating over years and decades. Think about what inflation at 4 or 5% annually does to your purchasing power over 10 years. At 4% annually, prices double in approximately 18 years. That means the retirement account balance that looks like it will support a comfortable life in 2026 will need to be roughly twice as large to support the same life in 2044. The number has to grow just to stay in place. And if the number is growing slower than the inflation rate, if your portfolio is returning 6% while prices are rising 5%, your real annual gain is approximately 1%, not 6, 1. Most people look at their account statements and see the nominal number growing and feel like they are making progress. They are on a treadmill. The treadmill is moving backward. And the speed at which it is moving backward, the rate of currency debasement, is accelerating in ways that the official inflation statistics are systematically designed not to capture fully. Stagflation, the word nobody wanted to say, and the reality nobody wanted to face. I said something recently that made a lot of people uncomfortable. I said the United States economy is already in stagflation, not heading toward stagflation, already in it. Stagflation is a specific and particularly cruel economic condition. It is the combination of stagnating economic growth and persistent inflation. It is cruel because the usual policy tools do not work against it. When the economy is growing too fast and inflation is high, you raise interest rates to cool it down. When the economy is slow and inflation is low, you cut rates to stimulate growth. The playbook is clear. But when growth is stagnating and inflation is persistent simultaneously, every policy tool that helps one problem makes the other worse. Raise rates to fight inflation, you make the debt burden worse. You slow the already stagnating economy further. You trigger the kind of recession that sends unemployment soaring and creates enormous political pressure to reverse course. Cut rates to stimulate growth, you pour more fuel on the inflation fire, you destroy more purchasing power, you accelerate the currency debasement that is already eroding the real wealth of everyone holding dollar-denominated savings. This is where we are, and the Federal Reserve knows it, and the Treasury knows it, and the administration knows it, and none of them will say it clearly because saying it clearly would trigger the very crisis they are trying to manage. But the markets know it too, and markets price reality whether or not the people managing the economy are willing to name it, which is why gold rose 65% in 2025, which is why the dollar fell against every major currency, including the Swiss franc, by 13%, the euro by 12%, the Chinese renminbi by 4%, and against gold by 39%. The market is not confused about what is happening. The market is saying clearly and loudly and with real money on the line, the dollar is losing its status as a reliable store of value. And the people who are listening to what the market is saying, rather than what the official narratives are saying, are the ones who are preserving and growing their real wealth while everyone else is running in place on the nominal treadmill. The three things driving this that are not going away, I want to be clear about something. What I am describing is not a temporary phenomenon. It is not a bad year or a policy mistake that will be corrected by a smarter Federal Reserve chairman or a more fiscally responsible Congress. It is the late stage of a structural process that has been building for decades and that now has its own momentum. There are three forces driving this simultaneously, and they reinforce each other in ways that make the situation more severe than any one of them would be in isolation. The first is the debt dynamic. The United States national debt is above $34 trillion and growing by approximately $2 trillion per year. The interest payment alone has crossed $1 trillion annually, exceeding the defense budget, exceeding Medicare, more than the government spends on infrastructure and education combined. And as existing debt matures and is rolled over at current rates significantly higher than what most of that debt was originally issued at, the interest burden will continue to grow even without a single additional dollar of new borrowing. This debt dynamic creates an almost irresistible pressure toward monetary inflation, because the alternative, genuine fiscal austerity, would require spending cuts of a magnitude that no political coalition has yet been willing to impose. And so the pressure builds, and the release valve is always the same. Print more currency, let the real value of the debt erode, and let the holders of dollar-denominated savings pay for it through the quiet theft of purchasing power that we call inflation. The second force is de-dollarization, the slow but accelerating shift by countries around the world away from holding dollar-denominated reserves and toward alternatives. Gold being the primary beneficiary, China's $800 billion in treasury holdings represents both a major vulnerability for the dollar and a potential weapon in any serious geopolitical conflict. The BRICS nations are actively working to reduce their dependence on dollar settlement systems. And every country that watched the United States freeze Russian dollar reserves after 2022 learned the lesson that dollar reserves can be seized, which means dollar reserves carry a political risk that gold does not. The third force is what I call the internal political fragmentation that always accompanies the late stages of a long-term debt cycle. When wealth inequality reaches extreme levels, when the people at the top of the wealth distribution see their nominal wealth growing, while the people at the middle and bottom see their purchasing power eroding, the political pressure to redistribute through spending becomes overwhelming. More spending means more debt. More debt means more monetary expansion. More monetary expansion means more inflation. More inflation means more erosion of the purchasing power of the people the redistribution was meant to help. It is a cycle that feeds on itself, and we are deep inside it. These three forces are not going to be resolved by a change in administration or a clever policy innovation or a new technology that makes everything work out. They are structural. They take years and sometimes decades to fully play out, and they have specific and historically consistent implications for which assets hold their real value and which ones quietly hemorrhage it. What the smartest money in the world actually did in 2025, and why most people missed it entirely. Here is the part of 2025's story that the financial media almost completely ignored. And I think they ignored it because acknowledging it would require them to explain something that is uncomfortable for the entire framework within which most financial commentary operates. The people who made the most money in 2025, in real terms, in purchasing power terms, were not the people who picked the best AI stocks. They were not the people who timed the market perfectly or found the right sector rotation, or executed a clever options strategy. They were the people who held gold, a 65% return in a single year, in an asset that the financial establishment has spent decades dismissing as outdated and irrelevant and unsophisticated, in a metal that pays no dividend, generates no earnings, disrupts nothing, and innovates nothing, in something so boring and so ancient that most modern investors feel embarrassed even mentioning it at a dinner party. Gold beat everything. It beat the S&P 500 by 47 percentage points. It beat Bitcoin substantially. It beat bonds by a margin so wide it should embarrass every fixed income investor who spent the last several years defending the traditional 60-40 portfolio as adequate diversification. And here is what I want you to understand about why gold did that. Not because there was a sudden new discovery of gold's properties, not because something changed about the metal itself, because something changed about the currency it is priced in, because the dollar, the measuring stick that most people use to assess their financial progress, lost enough value against real money in 2025 that the gap became impossible to hide. I said throughout 2025 that gold's rapid rally was not primarily a story about gold. It was primarily a story about the dollar, about the accelerating erosion of faith in paper currency, about central banks around the world quietly and consistently exchanging their dollar reserves for physical metal at a rate we have not seen in decades. Those central banks are not stupid. They are not naive. They are not gold bugs or doomsayers. They are the institutions with the most direct visibility into the health of the global monetary system. And what they are doing with their reserves tells you more about the future of the dollar than any Federal Reserve press conference or Treasury Department statement. They are buying gold aggressively, consistently, month after month, at prices that keep rising, because what they are buying is not exposure to a price going up. They are buying the only form of money that cannot be debased by someone else's fiscal incompetence. Stagflation's victims and why your retirement plan may not survive it. I want to talk about who gets hurt most by the stagflation environment I am describing, because this is not an abstract academic concern. This is a question about whether the retirement you are planning for is actually achievable on the trajectory you are currently on. The people who suffer most in a stagflationary environment are the people who did everything right according to the conventional financial wisdom, the people who saved diligently, who contributed to their 401k every year, who built a diversified portfolio of stocks and bonds, who bought a house and paid down their mortgage, who trusted the system. These are the exact people that stagflation punishes most severely, because their savings are primarily in dollar-denominated assets, because their bonds are losing real value as rates stay elevated, because their stocks are delivering nominal returns that look adequate until you measure them against what prices are actually doing to their cost of living, because their home, which feels like an asset, is becoming an anchor as mortgage rates make any move prohibitively expensive, because they planned for a retirement that assumed 4 or 5% average real returns from a balanced portfolio. And those real returns are simply not materializing in an environment where inflation is running at the rate that the honest measures suggest. The conventional financial planning framework was built for a world of moderate inflation, stable debt levels, and a dollar that maintained its purchasing power over time. We are not in that world anymore. We have not been in that world for years. And the advice being given to most savers and investors, the advice embedded in most target date funds and financial advisor models and retirement calculators, was calibrated for a world that no longer exists. I am not saying this to frighten anyone. I am saying it because I think the people who adjust their framework now, who update their mental model of how to measure and protect their wealth before the stagflation dynamics become undeniable to everyone, will be in a dramatically better position than the people who keep following a playbook written for a different era. What I am actually doing, and what I think you should consider, let me tell you what the evidence is pointing toward, not as a prediction, as a framework that I believe is more consistent with the forces I have described than the conventional advice most people are receiving. The first adjustment is in how you measure your wealth. Stop measuring it exclusively in dollars. Start measuring it in real terms. What does your portfolio buy? How much of your monthly expenses could it cover for how many years at today's prices? Is that number growing or shrinking? The answer to that question is more honest and more useful than the nominal percentage return your brokerage account reports every quarter. The second adjustment is in what you consider diversification. A portfolio of U.S. stocks and U.S. bonds is not diversified against the specific risk I am describing. Both of those assets are dollar denominated. Both of them lose real value when the dollar loses purchasing power. Real diversification in a stagflationary environment means owning assets whose value is not entirely determined by the health of the U.S. dollar. Gold, hard assets that produce income, international equities in markets with better debt dynamics, things that the dollar's decline makes more valuable rather than less. The third adjustment is urgency. The forces I have described are not going to wait for a convenient time. Currency debasement does not announce itself with a specific start date that gives you time to prepare. It has already been happening for years. It accelerated meaningfully in 2025, and I believe 2026 is the year that the gap between what people think their wealth is and what it actually is becomes too wide for even the most optimistic nominal framing to paper over. The people who look back at this moment and feel they made the right decisions will be the ones who made the adjustment before it was obvious to everyone, before gold was on the front page of every newspaper, before the word stagflation was used openly in Federal Reserve communications, before the retirement crisis that the current dynamics are building toward became undeniable. When one's currency goes down, it reduces one's wealth and one's buying power, even as their nominal prices rise. That sentence is the key to everything I have said today, and it is the sentence that most financial media, most financial advisors, most retirement calculators are not incorporating into the advice they are giving people right now. Your portfolio may be going up in dollar terms, your wealth may be going down in real terms. Both of those things can be true. Both of those things are true for most Americans right now. And the gap between them, the gap between what the numbers say and what the purchasing power says, is what I spend every day trying to close. Not for the people who are already wealthy enough to absorb the loss, for the people who have been responsible and diligent and trusting of a system that is quietly failing them. Those people deserve to know what is actually happening to their money. And that is what I have tried to tell you today. The measuring stick is broken. The dollar is not an honest measure of value anymore. And until you start measuring your wealth in something honest, you cannot make honest decisions about whether you are actually getting ahead. Gold has been the most honest measuring stick for 5,000 years. The market agreed in 2025 in a very loud and very expensive way. Make sure you are listening.
The S&P returned 18% last year. In gold terms, it fell 28%. Most people celebrated a great year for their portfolio while quietly getting poorer in real terms without ever knowing it. That is the stagflation trap. And Ray Dalio says 2026 is the year it becomes impossible to ignore. Your action this week is this: take your total investment portfolio value and divide it by the current price of gold. Write that number down. In 6 months, do it again. That ratio, not the dollar number, is your real financial scoreboard. What do you think? Do you agree or disagree with Ray Dalio's thesis that we are already in stagflation? Let us know in the comments below. And I will see you in the next video.